Everybody likes a good bargain, including when it comes to buying stocks. With that, we're diving for the best values in the stock market for the year ahead. Joining me now is Dmitry Khaykin, Managing Director and Portfolio Manager for ClearBridge Advisors Large Cap Value Strategy. ClearBridge Large Cap Value Fund is up nearly 17% over the past year, compared with 14% for other large cap value funds. Dmitry, welcome to the program.
Thanks for having me.
Before we get into stock picks, could you give us a quick summary of your investing strategy and what you look for in a stock?
Sure. The way we look at the world is very simple. We try to find the best, highest quality company, and we try to buy them at attractive valuation. So when you consider other value managers, the typical value manager would run a screen of inexpensive stocks, whether it's based on price to earnings, price to book, or any other parameter, and that's the way to narrow the universe for them. And then they'll do work on that subset of companies. We find that strategy somewhat flawed, and the reason being is that you can eliminate a lot of companies that for some reason screen to be expensive on those parameters. And I'll give you a very good example. So a company like Philip Morris International, which is a leading global company that sells tobacco products completely outside of the U.S., it looks very expensive on a price-to-book basis because it's highly profitable, it's been growing organically, and it's very high returns. So if you ran a screen, you would eliminate that type of company. But in fact, we think that type of company is very attractive for us as value investors. It's a very high return business. They generate a lot of cash, and they give back 100% of free cash flow to shareholders. So a good example of a company that we consider to be a high quality franchise is a company like American Express, which we actually think is a tremendous value at $56.50 right now. The reason we like American Express is because it's a global, one of the best global brands across pretty much any industry, including financial services. They own their own interchange, which allows them to capture a higher share of spending of their customers. And it's a model that is focused on spending as opposed to credit. So they want you to spend as much money as you can and pay it back as fast as you can. So it's transaction-based as opposed to credit-based. And those are the type of companies we like.
Dmitry, how do you distinguish between a value and a value trap? Because sometimes companies are trading at a cheap multiple for a reason, right?
Absolutely. That's a good question. And that's why we don't start with valuation as the first step of the process. We try to spend a lot of time trying to understand the business and the durability of the business model. Because if you just screen for cheap stocks, you inevitably going to get trapped in those value traps, as you said. So if we like the business model, then we'll decide how much we're willing to pay for it. So American Express is a terrific business model, should be able to grow at mid to high single digits top line. It's not necessarily the cheapest stock that we perceive to be a value, but it's really the high quality company that we are trying to buy below what we see the intrinsic value of the company.
Besides American Express and Philip Morris that you mentioned, what are some of your other favorite value plays for the year ahead, especially as some of the traditional value names haven't really been performing all that well?
So another company that we like, and it's been our holding in the portfolio for some time, is United Technology. It's a $74 billion market cap company. They have about $6 billion of cash, $28 billion of debt on the books. Stock is trading roughly at $80 a share. Last year or this year actually, was a transformative year for United Technologies. They made an acquisition of Goodrich. It was an $18 billion all-cash transaction, and it effectively repositioned the company to have more exposure to a long-cycle, predictable, and highly profitable aerospace market. If you look at Boeing and Airbus backlog of airplanes that they're going to build over the next 10, 20 years, the numbers are very high. So as suppliers to those two companies, they're going to have years and years of predictable cash flow, both for new builds as well as the aftermarket. If you look at the free cash flow of the company, they should generate about $5.5 to $6 billion. So about $2 billion that is used for the dividend payment, which has been growing, and we expect to continue to grow. And the remaining $3.5 to $4 will be used initially for pay down of debt, and over time to return, increase an amount of cash to shareholders. So the company should generate about $6 in earnings in 2013, and that number will ramp up very quickly as the company realizes very substantial synergies as a result of GoodRich transaction over the next number of years.
Dmitry, thanks so much for coming on the program and sharing your insight. I so appreciate it, and hope to see you soon.
Absolutely, my pleasure.